Our moderator for this session is Paul Davis. He is editor of the Community Banking Bureau at the American Banker. He has provided commentary on banking and other large corporations for BBC World News and the Nightly Business Report. Importantly to us, Paul has covered this conference since its launch in 2013. So when we thought about an unusual moderator, not one of our normal ones, we said, well, what do you think about this Paul Davis guy? And for some reason, Paul, you passed the test, so congratulations on that. And he has his finger on the pulse of issues that do matter to community banks. Paul has earned a bachelor's degree in government from the University of Virginia and a master's of business administration from Wake Forest University. Paul?
Thank you, Julie. And again, thanks to everybody whose efforts have made this event possible. And I think it's my sixth time at this conference, and normally I sit in the back, and so I've gotten a really good feel for what the back of everybody's heads look like, and this is a totally different perspective sitting here in the front of the room. So what we're going to do is we're going to have a nice conversation looking at kind of the idea of the future of community banking, largely through the lens of technology integration, a lot of the themes that we've actually seen earlier in the program today. We'll start off just with Kate. If you guys don't mind introducing yourselves and also just giving everybody a general sense of what company you represent, your business model, all that kind of stuff.
We'll start.
Okay.
Hello, everyone. Can you hear me? It works? No? Working? Better? Okay, thank you. Well, thank you for being here, and thank you for inviting me here. It's truly a privilege to be able to join this open dialogue between the researchers, the bankers, and the regulators. And yesterday at the conference, the FDIC chairwoman, Yelena, talked about how transparency builds trust. And I think this conference is a great example of that. Through this open exchange of ideas, it fosters a trusted relationship between the regulators and the bankers, and I think is ultimately great for a healthy banking industry. My name is Kate Howe, and I'm the founder and the CEO of Happy Mango. It's a FinTech company. So first, I'd like to clarify, because FinTech has been used many times at this conference. We are not a FinTech competitor. We are not one of the fintechs associated with the oligopolistic banking core processors. We are your friendly neighborhood fintech. We serve community banks. Community banks are our clients. Happy Mango is an online consumer lending platform. So there are three main functions we do. Number one, we help community banks digitalize their customer experience before, during, and after a lending experience. So we not only provide the online application processing and closing experience, but we also provide a personal financial management tool for the customers. Secondly, we help community banks to extend credit in their community, especially to those consumers who are considered credit invisible. We do that using our unique cash flow-based underwriting tool. And the last thing we do is we foster a collaboration within the community between the community banks and other collaborators, i.e. financial counselors and financial coaches. So yesterday at the conference, I think it was Jerry Cuddy who talked about the importance of financial education in his community. So to the extent that you don't have existing resources to provide that service, we can help you find those services, mostly free through the not-for-profit organizations in your community to provide financial education to your customers. So those are the things that we do at Happy Mango. I know one of our clients who is supposed to be here today, they couldn't make it. They asked me to say a few words about them. Okay, so I'm referring to Spring Bank, which is headquartered in Bronx of New York. It is a New York State regulated community bank. Their head of lending couldn't make it today because her son is getting married, so I guess she can be excused. Spring Bank have been collaborating with us since 2016. How we found each other was because Spring Bank previously had focused on business lending and commercial lending. And around 2015, 2016, they wanted to make loans, consumer loans, in their community. And when they looked around the market, most of the loan origination systems for consumer loans have FICO scores, credit scores, kind of hardwired in the process. When they use that, they basically have to decline almost 90% of the loan applicants. And for those alternative credit scoring systems, which were in the market, and they figured out they could use it, but it would be very hard for them to explain it to their regulators. So that's how we got together, and at the time we were working on our cash flow-based underwriting system, and we built the entire digital lending system for them. And since then, they have made over 2.5 million consumer loans in their community to over 1,000 New Yorkers. And most of these people have either no credit score or very low credit score below 600. So far, their loan loss rate is 5.6%. So I'm going to reiterate that. 30% no credit score, 70% with average credit score of around 600. And the loan loss is 5.6%. But I guess more remarkable than that is that almost all these borrowers came to them from other banks. There were not existing customers who had a depositor account at Spring Bank. But after they paid off the loans, those borrowers, 30% of those borrowers continue to put money into the savings account that they have opened at Spring Bank. So I want to mention, is there any bank commissioner from New York State? No. Oh, okay. Well, I think that's all for.
Okay, great. Well, again, with a name like Happy Mango, it should imply friendly neighborhood fintech, right? Yeah. Trevor, why don't you tell us about yourself and Mirador?
Sure. And wanted to echo Kate's sentiment as well. It's a privilege to be here. And Mirador is a small business lending platform where, like Happy Mango, we're not a lender ourselves, but we provide the software for banks to help with everything from customer acquisition of new small business customers through a digital process, in-branch, online, mobile. We can help with underwriting automation, some alternative credit models if the bank wants to use them, and then also help place loans that are declined to our network of CDFIs and other community development organizations as well. So that's briefly about us. Our customer base, we work with a lot of community banks such as Lewis & Clark, one of our earliest customers, to more recently some kind of regional and super regional banks like Zions and M&T Bank.
Great.
Great. Thank you. I've got a clipping from the Wall Street Journal. I thought this was interesting because, my name is Trey Moss. Jim brought this over to me and said, did you see that Oregon City was profiled in the Wall Street Journal this last weekend? So I have to show it to everybody. But the very first line says, I sat on the sunny patio of Oregon City Brewing Company. We financed the startup of that company. So I just wanted to share that.
That's great.
So, a little plug for community banking. So I think the reason I'm here is it's sort of an interesting intersection of rural life, capital markets, community banking, and FinTech. So I'll talk about that because I think it provides some perspective for you and then why I might bring perspective to this panel. I was born in rural Oregon, grew up on a farm. I really learned, I think, the importance of relationships, which later on ended up being very valuable in the community banking space. I have a particular affinity for community banks, and that's been with me since day one. I started out at Deloitte in Portland, Oregon, working on audits of financial institutions, and then later on fiduciary attestation engagements. Moved to New York to work in capital markets, M&A for the most part, primarily in the banking space, but a lot of different industries. And after 9/11, at the same time, my father contracted a terminal cancer, and so I got to go back to my roots. And I think that the rural life was really pulling me back, and so I went back to the Portland, Oregon area, and was the CFO of a community bank, and that's really where I got started inside of a bank. Very different experience than working on the outside of one. And at that point, realized that, okay, this community banking model that we're pursuing with this institution is a little bit different from how I might want to approach it. And I had the same sentiment as the chief lending officer. And it was really his idea. He was frustrated. He said, we got to just start our own bank. And I think I was on a panel 3 or 4 years ago here, and I said, I would do it. I would do it over. I wouldn't do it a second time. So we started the bank in 2006, right before the recession. But going through the recession was really, I think, quite a learning experience for a lot of us, and those of us that survived. I got involved very heavily in advocacy on behalf of the banking industry, and I'll talk briefly about that. But going back to the learning experience, I want to talk a little bit about also the importance of specializing in something. And that's probably something we can do later on when we talk about opportunities and threats, because there's some real advantages if we do it right. We're able to manage the risk, I think, very well. In fact, I'll save it for later, but it was amazing the level of delinquencies that we had that lost almost nothing from a charge-off perspective through the recession for the life of the bank itself. I got involved in advocacy at the state level, so I'm on the board currently of the Oregon Bankers Association, the Community Banks of Oregon. Chairman of the board of Synergy by Association, which is a group purchasing organization for over 1,200 banks across the nation. Just outgoing chairman of the ABA Community Bankers Council. I'm on the Bankers Advisory Board for CSBS, and I just took on the first part of this year the Chief Executive Officer role of Sheltered Harbor, which is the backup of last resort for the entire financial industry in the United States. The participants represent 70% of all U.S. deposit accounts and 55% of all the retail client brokerage assets. We're trying to get that to 100%, predominantly through the community banking space. But I bring that up because this broad cross-section of community bank exposure across the United States, I think, hopefully I can bring somebody to the panel, and again, it just reiterates the fact that this is the industry that I live for.
Great. Well, what we'll do is we'll start kind of talking about things in a kind of a broader sense, and whoever feels like they want to jump in, just go for it. But so we talk about the idea of the future of community banking. What is it going to look like? How are banks going to differentiate themselves? I was just kind of curious. I mean, let's just talk in general terms about the opportunities that are there for community banks.
I'll get started. I learned a lot from yesterday's conference. One of the things that was also talked a lot about is relationship lending or relationship banking. And I think that for community banks, relationship is a real asset. And I see a lot of opportunities for community banks to continue to build on that. I'll use an example I'll use Spring Bank again. When they first started launching the consumer lending program, the most successful distribution channel was through their employers. And those employers who were their business borrowers. And so they were able to extend and broaden their existing community relationship, and with the help of technology. So I think that those relationships built in the community could bring a lot more relationship, a potential more opportunities to the community banks.
I kind of building off of that, I do think that kind of having a niche and being able to provide a lot of tailored advice we've been seeing is something that's, I think, really unique for community banking. It's something that larger institutions try to do purely through technology because that's the only way they can really scale it, and it ends up, I think, kind of ringing pretty hollow to a lot of, in particular, small business owners. I'll give you just kind of a quick example, just personally. When I started Mirador at the time, we're venture-backed, had a lot of big checks that we were ready to deposit, but we were just barely starting up. And going to several banks in the Oregon area, they looked at us like we were crazy, like, so what are your revenues? We have none, but we want to put several $1 million on deposit with you today. And they were kind of thinking like, something's weird here. I don't want to touch these guys. And then we ended up banking with Silicon Valley Bank, which knows the tech industry, and it was a very different conversation. It was, who are your investors? Oh, we know them. Which partner invested? Oh, great. Here's the plan we have. Here's how we'll help you grow. And it felt, as a business owner, really good that somebody knew my industry, knew the kind of nuances of how we operated. And we hear that time and time again from our small business owners that we help facilitate loans for. And the feedback that we get on behalf of our banks and pass on, generally the positive feedback is in that category of, they know my particular business, they're really good at underwriting, fill in the blank, restaurants or practice finance. And we found that those high satisfaction scores really come with kind of having a niche and really being able to kind of look past the pure numbers when it comes to underwriting and be able to understand where, okay, this might be a credit policy exception, but we think it's fairly low risk because of these other factors that wouldn't come out if you're just purely looking at the numbers.
I'm trying to decide whether should I focus on opportunities or threats first.
Let's go with the opportunities first, because
Okay.
apparently what we saw in the results here is that FinTech is friend, not foe. So
Yes.
But yeah, let's talk about maybe even build on what Trevor's talking about in terms of niches and opportunities, especially areas where the technology that we're seeing now can actually supplement and augment that kind of strategy.
Well, that right there, I think, is the biggest opportunity, and it's most of my notes were on this one particular topic, and that is being a niche bank, maybe not entirely a niche bank, but really pursuing opportunities in either different lines of business, and I know this is a terrible word to use in this venue, but concentrating in something that you really know a lot about. Focusing on, it could be a demographic, it could be a type of loan, it could be a market area geographically. I think it's the only way that we can, when we start hitting a soft landing in the economy, because right now the economy is in our favor. Certainly those that made it through the recession are able to capitalize on that. When we do hit a soft landing, which at some point we will, I want to be prepared for being able to weather that, not just with capital, but also with things like economies of scale. And for a small institution to have economies of scale, we have to have those within certain areas of our business, as opposed to being a small version of a large diversified bank. And so I think later I'd like to talk about, is that okay? Are there risk management opportunities there versus risk mitigation and risk aversion? So number one would be niche or concentration, and don't throw things at me. And then there are a couple other areas, and that is we are agile enough to adapt. Mm-hmm. So we're small enough. It's not related to the oligopolistic core that was discussed by Kate and earlier today. It is difficult to move that ship with Fiserv FS and Jack Henry. I think for us, it's not that difficult if we feel we have a direction we need to turn. Certainly, we have to evaluate the balance of resources and rewards for that particular, and exposures to that particular decision, but we can turn very quickly. Accessing technology certainly is at our disposal, and more so now than we've seen even just a couple years ago. Well, I think it is recognized that it is not competition for us. Certainly for the smaller fintechs, the startup fintechs, there's a little bit different issue that we have, and that is making sure we can align in culture. But being able to access those is, there's more now than we've ever had. And then finally, I think being able to leverage the fact that we can connect with people. We're not just providing a platform that is sterile or faceless. We can connect with people. So if we can take that strength that nobody else has, and nobody else can be trained to on a large scale, and leverage technology to amplify it, that's where I think our biggest opportunity is.
To kind of follow up on that, we're with the discussion kind of going down the path of talking about niches, demographics, concentrations, if you will. Do you think that the idea of the term community and community bank is kind of evolving as we move forward? I mean, it's not just, in some cases, the local bank in terms of we're this town's bank. I mean, you can define community in many different ways now with technology as an enhancing part of that.
Yep, I think that there's definitely a point about that. And I'd like to pull up slide 48. Here is a slide that I have, I got this slide from FDIC research that was published in 2012. I think Jim and his team kindly updated it for me. This is really great. So it shows the percentage of assets for community banks. And at the beginning of the early 90s, there's almost close to half of the loan assets are consumer loans. And that just declined over time. So when we talk about communities, community are made of people and made of consumers. So should there be a higher percentage of loans made to consumers in those communities? Who are making those loans today? So for a period of time, the larger banks are doing a lot of those consumer lending, but that seems to have peaked. And in my mind, that is another opportunity for the community banks to pick up. And we read in the headlines about the challenges of managing cash flows for many American consumers. And I would characterize particularly a segment of I would call the third quartile. People who are making income at the middle or lower to middle income. At that segment, they have an income, but they have a lot of income or cash flow gaps that they need help to manage that. And a lot of them, when they turn to larger banks, they do not get that cash flow management products that they needed. So they don't have good credit, and they can't apply for the credit cards that are the affluent consumers will qualify for. So I think those are the consumers, and serving their needs to help them manage their cash flows could also be a great opportunity for community banks.
The other thing I'd add that I think this gets a little bit to advice, it seems like over time, banks have kind of turned more into product companies, the way I'd say it, where they're just delivering a product that's increasingly commoditized. I was at another research conference, and when they were showing over time where small business owners turn to advice, and if 2 decades ago, their banker was kind of the first place they would go, and then you'd have accountant and lawyer and friends. Now bankers are down in 4th place. They go to their friends over their banker. They go to their accountant, their lawyer over their banker for financial advice. And that's, to me, absurd. And I think it's because there's been this race, and maybe some of it is with pressure from technology toward providing the lowest cost products that are out there. And I think that we're seeing that small businesses in particular are really hungry for advice. And that's, I think, a competitive edge that community banks can have over not only the large banks, but also all of these non-bank actors. There are going to be non-bank actors out there like Amazon. If you're a merchant on Amazon, they've done a couple billion in loans to small businesses to date. You're going to be hard-pressed if you're a bank to make a loan that's faster than that, because they're purely underwriting based on their inventory, based on the performance of the platform. There is literally no application or underwriting. The loan is just there and offered. Same thing with Square and a lot of the point-of-sale providers. It's going to be hard, I think, to compete on that level as a community bank in terms of the speed, but you can absolutely compete when it comes to advice, and we've seen small businesses really hungry for that, hungry for somebody to help them understand what type of credit, what's the right product for them, how do they better manage their business over time to be able to kind of achieve their goals. The small business owners are generally not all that financially sophisticated. Only 2% of small businesses with revenue under $1 million have somebody who's a CFO or kind of a financial background. So it's very kind of needs-driven, seeking credit, as you guys know, and folks that are not particularly sophisticated borrowers.
But I would also interject, say, in a market like we have now, right, where you have larger banks, you have non-banks, a lot of competition. It's hard to be able to be that advisor and actually monetize it and actually make that trickle down to the bottom line, correct?
Perhaps, but I think that there's also, you see small businesses vote with their feet on things other than purely price. When we talk to a lot of community bankers, they think that I've got to have the lowest rate out there. That's how I'm going to win business. And sure, I'm sure there's some that are very focused, some borrowers very focused on that. You also see small businesses that are going to non-bank sources and they're paying 30, 40, 50% APRs because it's fast, it's convenient. or they're kind of getting some kind of advice somewhere else. So I'm not implying that community banks start charging 50% APR for the advice, but there's a lot of room in there where you can still be charging very reasonable rates and monetizing it. And I think that it's particularly in small businesses, there are a lot of other factors at work than purely the rate.
Okay.
Yeah, no, that's a good point. I didn't talk about Lewis and Clark Bank earlier, but it is I mentioned in 2006 it was launched. It's about a $200 million commercial bank in Oregon City, which is in the Portland metropolitan area. It's focused on the loan side, almost exclusively on the commercial lending side, and then on deposits, a mix of commercial and retail. But I would certainly echo what Trevor is saying. There is when we look at advice, and I think that's, let me preface it by saying that I think some of this move towards standardization or commoditization is driven in large part by the industry. So 20 years ago, I think we saw some charts that would support this, but 20 years ago it took 85 of the top institutions to achieve 50% of the U.S. banking assets. Today it's 9. I think what happens there with so few institutions that constitute the majority of the banking assets is that they have to be standardized. And in doing that, and I think it's doubly impacted, I think, somewhat by coming out of the recession, the scars that we have coming out of the recession in terms of risk mitigation and de-risking. So the combination of the two, I think, makes it difficult for us to pursue anything that's sort of outside a really narrow corridor. But to your point on providing advice, you're right. There is no question that business owners will pay for customized structure, will pay for strategic advice, will pay to know that they're headed the right direction when it comes to financing an expansion of their business or an opportunity that they want to pursue. That's certain, I mean, our loan portfolio is testament to that because the entire loan portfolio is made up of a mixture of loans and to small business owners that are looking for that and have paid. Our yields are very strong. That's why. There's definitely something there. It's capturing it that I think is a big opportunity we can leverage technology for.
Great. Well, let's shift gears to, let's not say threats per se, but let's talk a little bit about some of the slides from the study, particularly slide 40 here. I know it's here. This one. The idea of the competitive landscape. Obviously, when you looked at the first slide, FinTech was really, really low, hardly a blip. Obviously, at some point in the future, this is what community bankers see as their landscape. I was kind of curious if you had any takeaways on that. I mean, do you think those numbers, from your experience, seem on point? Do you think there's anything that, just what's your thoughts on that? I know, Kate, you had some thoughts about some of the who you think are going to be the kind of the bigger competitors in the community banking space.
Yeah, I don't feel, maybe I am a FinTech myself, I don't feel FinTech should be such a threat to community banks because there's a lot of things that banks do that FinTechs have no idea what to do. And today, the most prominent FinTechs, if you look at them, every single one of them is a monoline, be it Cabbage or Lending Club, and not a single FinTech has been able to provide a holistic customer experience for financial services. And in terms of risk management, in terms of maturity transformation, all of those critical functionalities that the banks provide, I don't think FinTech companies have the expertise to do that yet. Some of the emerging technology, such as AI, people feel a little nervous about, what if AI, Alexa is going to replace my bankers, or Tyler's, all of that. Is it possible? It could be sometime in the distant future, but I would ask Alexa for whether I probably will never ask Alexa for banking service, options. So that's my view. I think there will be more technology for sure in the banking and financial services, but there are some core fundamental businesses that's embedded in the financial services industry that cannot be replaced by just the technology.
One thing I thought was interesting is that large banks came in as low as they did. When you just kind of look now, coming out of the recession at the pure numbers, Chase, in a lot of circles, they run these technology conferences and say openly that they are considering themselves in a transformation to be a technology company that provides banking services. They have over 20,000 software engineers that work for Chase alone. Citibank is investing $8 billion in technology. It's some pretty staggering numbers that I think will be interesting to see going forward if the large banks start kind of moving up in that survey and seen as bigger threats. Where over the past few years they haven't really been, because they've been really focused on compliance and kind of shoring up, their businesses coming out of the recession.
Yeah, I mean, the primary competition we receive from the larger institutions, that would be anybody really under probably 10 to 15 billion, is on price and using the traditional funnel method. Yes, we can do this, and then they'll get as many as they can in the funnel, and generally 45 to 60 days later, kick most of those out of the pipeline. Certainly from an advantage standpoint, we can, as community banks, be able to tell very quickly up front, does it look like we're going to be able to get there, and here's what it would take. I think our primary competitors, though, right now do reflect that. Our credit union competitors are very aggressive, particularly on price and terms and loan structure. There's very little expertise in those areas, even when they are recruited over from the banking space. And I think that can be problematic for that industry from a systemic standpoint. It's something to watch for those of you that supervise both banks and credit unions on the state side. I'm sure it's nothing new there, but just to be aware of. We certainly have experienced in other community bank peers of mine around the country have as well. But by and large, our primary competitor is the banks that are under more like 10 billion.
Mm-hmm. But that's also probably indicative of the size of customers that you're targeting as well.
Yes.
Right.
Yes, and complexity.
And it's interesting, it's not just on the lending side. I wrote an article about maybe a year and a half ago about when Bank of America was selling off all their branches in some of these smaller markets. And the banks that were buying those branches were not getting as many deposits at the time of closing as they thought they were going to get when they agreed to do the deal. And as I started talking to some of the bankers involved in this, they lost a lot of their deposits to Bank of America, because even without a branch, they had a platform where these people could still transact. So I mean, I think that's something to think about as well. And you had talked, Kate, a little bit about your thoughts about the Amazons, the Googles, those kind of companies. Are those really a threat at some point? I mean, you did talk about Alexa, but is that really something to think about?
I think if I were a community banker today, I would feel especially if I'm sitting here, I would feel very safe about the potential competitive threat from Amazon, because if I look around me, I see my regulatory friends, and they will help me to keep those threats away, because it's tough to get for a size of for a company like Amazon and Google, that size of company to become a bank holding company today, they have to go through a lot of regulatory transformation. So I think it could be a daunting task for them, and comes back to for some time the most successful FinTech companies have been providing very, very limited financial products. There's no way in comparison to a full-service financial firm. So in my mind, there might be some threat from those larger technology companies, but I think it's still a very distant threat.
I take a little bit of a different view on that. That I think that, one, we're starting to see some, as you guys know, some regulatory change, the OCC charter, and some kind of easier ways to bring non-depository institutions into the regulatory framework. Personally, I imagine some of that is based on that they're starting to offer these services anyway, and we all, I think, would collectively feel better if there is some supervision to it. But I do think that these non-bank institutions, they're really good at, one, understanding their customer, and two, iterating very, very quickly. This is not the way that they don't push out technology the way that banks adopt technology, which is let's look at a whole bunch that's out there, let's do an RFP, let's take a lot of months because we're really, really worried we're going to make the wrong decision and have to kind of roll it back. These companies roll out new beta products all the time, and they've trained consumers to understand that, you know, it's not always perfect, and then they sometimes roll it back, and they quickly learn and iterate and learn and iterate. And I think that the thing that I see as a big threat is if the banking industry is not able to keep up on customer expectations, folks are going to start kind of going elsewhere, even if it costs them a bit more. Because, you know, all of the bank customers are consumers first and foremost as well. And they're being trained by Apple that you can order something online, you can pick it up in the store. When you walk into the store, they know who you are. You don't have to wait in line to check out. They've created a nice online, offline experience. I think those expectations are starting to show up in kind of other aspects of their lives. And I don't think the change will be, you know, next year or in 5 years, but I think that, I do think the banking industry can compete very strongly, but has to start, I think, collectively getting a little bit better at adopting technology at a faster pace and being able to kind of iterate and experiment a little more. If you think about historically, financial technology innovation came from the banking sector. I mean, banks started the credit card system, and, you know, ATMs, all that was born out of banks, and we're not seeing that innovation now within the banking community. But I do think it can come back, and if it does, the regulatory framework, the access to low-cost capital will make it pretty hard for these companies to compete with the banks if they can, in my opinion, get a little bit faster and more nimble on technology innovation.
So I'm going to add to that. I do agree with you on the from customer experience perspective. All the technologies companies definitely has set the bar very high for all the rest of the industries, including the banking and financial services industry. But I think with the help of technology providers like us, banks can catch up with those technology with the main technology companies. And I think that there's some deeper side, the relationship and also the risk management side of the business will be difficult for the larger technology companies to be able to adopt that kind of expertise.
Let's talk a little bit about the whole idea about technology. We've talked about also the relationship nature of community banking. At what point can technology really help? But at what point, you know, obviously it can help, but at what point is it really more about the relationship? I mean, technology can't completely eradicate the need for human interaction, right?
Yeah, I absolutely agree. So, for example, on our platform, we can automate a number of things, including, you know, the application and closing. But some of our clients purposely choose not to have the closing done online if it is a new customer. They want the customer to come into the branch so that they can shake their hands, look at them in their eyes and smile and welcome them to the new bank, or maybe give them an apple pie. So I think all of it's hard to quantify the impact of that, but that is something that could be lasting.
I was going to say, and that's even reflected, I believe, in the study as well. I mean, we have this chart right here that shows that, you know, a large percentage of community banks are open to accepting applications online. But we don't have the slide, but if you look in the study, a much smaller percentage are actually interested in closing online. So, I mean, that goes back to your point there. I'm assuming that's also one part of the customer, but also part of the bank itself, wanting to keep that kind of that personal touch.
That makes sense to me. I think it's a misnomer that it's either personal or technology. The best technology enables that personal relationship, if you think about it. Technology, in my view, should do the things that are kind of mundane, and that would take you a lot longer if you're doing a human interaction. So, you know, why make somebody walk into a branch to transfer money between accounts? Why make them walk into a branch to deposit a check? There's not really any kind of value in the human interaction there. But when you're closing a loan, when you're talking about how is your business doing, help us understand the right structure of credit for you, that's highly valuable to have human interaction. And I think good technology, even in the lending space, can take care of the mundane things, data collection, application, stuff that would take far longer if it were paper and pencil based, and save the really high value interactions for the person-to-person interaction. And if it's done well and seamlessly, where it doesn't feel like two processes, they can kind of, in that Apple-like store experience, I think it in fact enhances the relationship. Because people say, wow, you made this really fast, this is amazing. I didn't have to repeat myself to 4 different people, you already had all my information there. And that rubs off as strengthening that relationship. And so I really see it as an enhancement to community banking if it's done correctly and weaves in humans into the process.
Yeah, no, it's very much aligned with the idea of using technology to amplify what we do best. And well, we talked about the future of branch facilities as well. And I think that's something that folds into this very clearly, and that is the future of the branch is less transactional. It's hopefully going to become more high-value interactions where we're talking about where somebody is in the stage of their life, where their business, where they're going, how we can help, or where we've seen it be successful and where we've seen pitfalls, so that we're looked at as a trusted advisor. I hate to hear that we're number 4 on that list.
I mean, I have friends of mine that I would never turn to for financial advice, and yet somehow they're ahead of the banking industry in a lot of ways. That's strange.
That is interesting.
Yeah.
So no, I would certainly echo what Trevor was saying, and I think one to dovetail off something you said earlier, then I actually had written it down when in preparation for this, and that is rapid iteration. Is there a way for us to take advantage of rapid iteration of whether it's business lines, whether it's technology, something to find because otherwise what's going to happen, because we are so concerned about risk, is that, and I love the differentiation yesterday of we're risk managers. I think if we can get away from the idea that we're solely risk mitigators or we're solely risk averse and really manage that risk appropriately, I think part of that equation can be for us to rapidly iterate. So how do you quantify that? Well, I love Bob's paper earlier because I think it puts some quantification on how much capital does it take and what does that mean. So if we're willing to, say, allocate 2%, if Lewis and Clark Bank has $22 million in capital and we allocate 2% of our 11.5% capital, or Tier 1, that is the equivalent of around $6 million in pre-tax capital. I mean, that's a tremendous amount of money to allocate. Say, yes, you can start taking some risk in these particular areas and really iterate. At the moment, it's our approach is to mitigate as much as we can just because of the headache. So, but that's part of the threats, which I can talk about later.
Well, and actually, it's great that you guys have brought up a couple of points, because I think I can really move us into another section of this talk. And I mean, you mentioned, Trevor, that banks have the ability to innovate. They still have the capabilities of pushing things forward. You mentioned risk mitigation. Do you think, so the idea is, why has innovation moved outside of the banking industry? Is it that idea of risk mitigation? Is it, financial control? Why have banks kind of given that territory up, in a sense, to other firms?
I can give my own personal perspective on that. So I think there are a couple factors, and it's interesting because, at least from my perspective, and I think those that I know well, we as bank executives and leadership want to do the right thing. We want to do the right thing by our community. We also want to do the right thing as a leader of our institution. We want to do the right regulatory and safety and soundness and compliance thing. So I would encourage you to always keep that in mind, because it's not an adversarial relationship. It should be an aligned relationship. But I think what's happened since the recession in particular is we're still, on the banking side, we're still very much scarred by what some of us went through. And I'll give you an example. I testified at the first Agrippa hearing in LA. It's the very first one, 3 years ago. And at that hearing, I mentioned that we'd welcome 19 examiners into our bank, little bank at that time. And if we extrapolated that onto the sort of the employee ratio to the largest institution in the U.S. at that time, it would be the equivalent of 86,000 examiners on site at J.P. Morgan Chase. But it gives you the sense that the amount of it felt very confining, and so it's almost a bit scary to step out of bounds. And I think that has not left a lot of our psyche yet. Over time, hopefully it does. So I would encourage a sort of a cooperative relationship to say, you know what, it's okay to take some risk, but in more than one area, as long as you've addressed it appropriately. So I think there's going to be a little bit, and I can give you another example on the compliance side that unfortunately caused our board to decide to exit residential mortgage, which I didn't want to do, but it was too much risk for us to take on from a compliance standpoint because it crippled the rest of our business model. Yeah, so if we can address those, I think that it would go a long way.
And I think the thing that just, the overlay that also makes some of this worse and harder for innovation to sometimes be inside banks is, you think about the technology companies, a lot has changed in the last 20 years in the way that technology companies develop software. So 20 years ago, software was done in a much more kind of waterfall approach, and what the software industry calls waterfall, where it's first like we're going to spell out requirements, we're going to kind of gather everything, get it all spec'd out to every little kind of detail, know where every button's going to go, then it's going to go move over and go into development, then there's going to be quality assurance, and there's going to be testing. And kind of throughout this whole process, the good thing about that is it lets people get very comfortable with where the software is going to come out. And it takes a long time, and therefore provides a lot of time for example, regulators or other stakeholders to be able to understand what the software is doing, pressure test it, things of that sort. The software industry has now moved to agile development, which is a very different process. It's where you are kind of finding needs, you are understanding the requirements, building them in short 2-week engineering sprints, they even call them, engineering pushes. You're releasing code every single day, sometimes multiple times a day in an automated fashion, and you release, learn, test, kind of all in a very short cycle, and then work on the next little piece. Learn, what did you learn from that? Now let's develop more code, let's quickly test, let's release it again. So it's these short little loops instead of kind of a long arc. That's really hard, I think, if you're, you're a regulator, you're concerned about, security or things of that sort, to really feel comfortable in these short iterative cycles. Now, agile processes are not insecure. Security is built in from the ground up, and companies kind of do that as part of it. But I think that you kind of layer that on top of it. What's happened is the banking industry is more comfortable with a much more waterfall, long arc approach, and the rest of the technology industry is iterating very, very rapidly, very quickly, and therefore the customer experience is diverging. And that's where I think also kind of compounds this, why you're seeing a lot more innovation come from outside the banking industry now in financial technology, just because they're able to hone in on and perfect that software at a much, much faster pace.
What would it take to kind of change that? I mean, obviously we've got an audience of regulators. I mean, are there things that can be done on the regulatory front to bring back innovation? Or is this really the direction that it's going to go, and we need to talk more about collaboration rather than, building stuff in-house?
I personally love the idea of a technology sandbox that's starting to kind of get some traction in Europe, and I think the UK in particular. Idea there is, let's carve off kind of a walled, protected area of the bank. So we're not going to make sure that a bank is putting too much capital at risk. We're going to make sure that they're not putting taking on unnecessary risk when it comes to customer data, but give kind of a small area for them to be able to test new technologies with much lower third-party diligence requirements, much lower regulatory oversight, but it's in a walled, controlled area that doesn't cause overall systemic risk to the institution. And then as they kind of test and rapidly iterate and figure out what their customers need, what their customers want, then when they're ready to roll it out big, great, then go through the normal kind of third-party diligence regulatory process to make sure that that is safe and sound and really secure when you roll it out broadly across. So I think it gets to Trey's point of, it's a concept of risk mitigation and risk management, I guess, rather than really trying to manage risk down to zero. So just I think that would allow the banking industry to work with FinTech companies at a much faster pace, or even in-house be able to kind of develop and test at much lower expense and cost to the bank, but still do it in a way that is going to be secure and safe and sound.
Can I just throw it out to you, Trey?
Yeah.
Is that something that would even work within the construct of, say, Lewis and Clark? Something, or is this really something more for larger institutions?
Yeah, and I mean, it should also apply, I think, beyond FinTech applications, and really sort of our approach to business lines that we might specialize in from a niche perspective or technology. But so can I give some perspective on? Okay, this my wish list for FinTechs. One is we figure out how to integrate with cores. I know that's your challenge, so that's not. But I mean, when I think about adoption, if it were turnkey like that, it makes it a lot easier. And I know that's a wish. I said a wish. I know it's a wish list item. Another one that I think is a challenge is the investment, and that was brought up earlier. So if the investment upfront is too much, that's generally, there's only so much you can allocate and so many resources internally we can allocate also, so whether it's dollars or it's people, to get something implemented. And that's something you've done very well, by the way, is setting up a model that makes it easy for us to test something out without having invested $100,000 or $50,000 or whatever the number is. But, very affordable. So kind of pay as you go or success based. And the final one, which I think is probably even more important, is that we somehow align the culture of a traditional FinTech with the culture of, so the entrepreneur that sometimes shoots from the hip or ready, shoot, aim, to a bank leader who is, or a chief compliance officer, is even more of a risk mitigator or risk eraser. So if we can somehow do that, because when it comes to vendor risk management, when it comes to vendor due diligence and all of the requirements that we have, and ensuring that we're not putting the bank at risk from a compliance or a safety and soundness perspective. Well, if we had those dialed in, I know Mirador does a good job of that, but I mean, in general, for FinTechs, it would really help with a rapid iteration because it reduces that perceived risk, I think, both from a banking perspective as well as a regulatory or supervisory.
Gotcha. And Kate, I was going to ask you, we've talked about in-house, but let's talk about collaboration again, right? Community banks working with FinTech. From your perspective at Happy Mango, I mean, how do you help community banks become more comfortable with that kind of collaborative partnership? I mean, I'm sure there are going to be some that are ready to embrace it. There might be some that are a little bit skittish. I mean, how do you have those conversations to try to get them to feel more comfortable working with you guys?
Well, it comes down to relationship building, which I think many of you sitting here are so good at. And then, deciding which FinTech to work with is a big decision. I think to know the management team, to understand the management's background, to see whether the management not only can fulfill your current technology need, but can even can understand and appreciate your vision for your business, for your bank, and can anticipate your potential needs. I think those are very important factors. And also, I want to touch on some of the points that were mentioned earlier. When FinTech, the emerging FinTech, like the one that Trevor and we are working on, is very affordable. It is affordable because that's the nature of technology. The nature of technology is such that something that cost hundreds of thousands of dollars to build 30 years ago, when it comes to storage costs or computing power, nowadays it only costs a few cents. So when I read in the survey, it says that the high cost of technology, I had to scratch my head. So what do people mean by that? And I would also like to ask the researchers in the C2, why is it that by nature, technology costs you to decline over time, but why is it so costly for community banks? And also, we heard the discussion about larger banks seems to get more out of their technology investment than smaller banks. Why is that? I have an intuitive answer, and this is something that other people have touched on as well. It is the market structure of today's technology providers for the banks. So everyone in this room, regulators, bankers, have a very healthy fear about the concentration of the banking sector, right? We don't want banks to be too big, to fail too big, too concentrated. But if we look at the technology providers for banks, they're way more concentrated than banks. So the top 3 core processors occupy more than 70% of the market. If you look at the top 3 banks, they have less than 30% of the assets. That's a very, very different level of concentration. And especially when it comes to community banks, when you're at the negotiation table with such big behemoth technology companies or your core processors, that relationship is very lopsided. And in my mind, that could have hampered the innovation of technology in community banks as well. So I would like to encourage the researchers in this room to take on this initiative to look at what is the impact of that oligopoly market structure have had in community banks' innovation. And And also, I would like to also make a recommendation, I think, to summarize what you guys said about innovation and the regulators' oversight. There is an earlier analysis on stress testing of capital of community banks. It looks like community banks have very, not more than sufficient amount of capital. So based on what Trevor and Trey have been saying, could we recommend the regulators, the field examiners, to consider letting community banks size a portion of their capital as capital for innovation? Risk appetite, size of a percentage of capital for innovation, and maybe adding that to the examiner's handbook. And so, because innovation, as we all talked about, necessarily involves making mistakes, and there will be losses, financial losses. So if we can let the banks size a certain amount of capital that they can play with, and that will help the industry to innovate as well.
Well, great. Well, thank you guys, and great suggestions. I wanted to leave a little bit of time, obviously, for some questions. So no questions off limits. Anybody? Alan, why don't you go first?
Okay. Thanks very much. Very, very engaging panel. I have a very fundamental question about the cooperation between community banks and FinTech lending platforms. Now, when we think about how do banks or lenders get information about the borrowers, we think of 3 channels. One is screening before the loan is made. One is monitoring the borrower to make sure that they're doing the right thing with the money. And one is gathering information through relationships. Now, we know, I think it's pretty clear that fintechs are very good at screening before the loan is made, but they don't probably really know how to do monitoring or relationships. So my question is, when a community bank invests money with a lending platform, with a fintech lending platform, do they actually fully cooperate and do the monitoring and relationships also?
So for consumer lending, that on our platform, your assumption of number 1, 2, and 3, right? Number 3, in terms of the information you get through relations, that's hard to build into software. So that's not something we do. But number 1 and number 2, both of those we cover in terms of screening and in terms of ongoing monitoring. So we have the ability to continuously aggregate an individual borrower's financial data across his or her financial accounts and continuously monitoring that and provide that information to our bank lender.
And I would say that they're in both those kind of number 2 and 3, the monitoring and the relationships. Technology can provide some additional data that might not always be obvious, and so I think it can be powerful if it's coupled with kind of humans on there. And what do I mean by that? I guess one is if a borrower, for example, is connecting up their accounting software and bank accounts elsewhere, that's data that's automatically can be sucked in and built into the monitoring systems that the fintech is using to give a banker a much more up-to-date and kind of real-time analysis. So they're able to kind of sometimes spot some trends earlier than it might be, okay, there's now a missed payment. Well, it's almost too late, where if you can start seeing, all right, it looks like you guys are going to run into a little bit of a cash flow issue 3 months down the road unless something changes. So there's some additional data that I think can be provided in real time. And similarly, on the relationship side, they're being able to pull in data out there that is kind of a proxy for customer sentiment. So whether it's online reviews, whether it's the effectiveness of marketing campaigns, things of that sort. There's some additional data, shipping data, that some of these guys bring in as well that could help give a banker some insight into the health of the business and kind of how are the customers doing it when it comes to monitoring.
Any other questions? Yeah, we've got one right here.
You were commenting about the speed as to which banks bring technology and as slow as it was, and I remember back when we brought ATMs online and all. But you two who are not in the banking industry, you both provide technology, and you don't have a risk assessment that you have to do for your technology. You don't have to check to make sure your customer is compliant with any of the compliance issues that come along. You don't have to check to make sure they pass BSA tests that we all have to do in advance. So from your perspective, how does that delay banks from bringing technology? I hope that question makes sense, is that the upfront cost to us is different than to you who's out there without any regulation. Would that be an accurate statement?
I think that could be an accurate statement for many fintechs. Mirador is not a lender ourselves, so we're purely a software provider. So we do have to build into our platform all of the compliance pieces as well. Because if we don't build that in the platform, you guys are not going to be able to provide that information easily to the regulators when they're asking for it, and it's not a good business model. So we're having, when HMDA is rolling out, we have to incorporate that into our platform. We have to incorporate, BSA, AML controls into the platform. But I do think that, yes, for completely non-bank lenders or lending themselves, yeah, that is an advantage that they have. And I think that where community banks can compete is on the relationship side, is on lower cost of capital. And I think that they do still have to kind of make that process somewhat easy, or we're seeing, particularly in small businesses, will pay more for ease and convenience in terms of a rate. But yeah, I think you're absolutely right that non-bank lenders do have a lower burden when it comes to compliance, certainly. It also opens them up to some additional risks as well. I think in the next downturn, and we've seen some things with Lending Club and some of these others as well, where they've had a couple high-profile kind of issues where if they were a little more on their BSA, AML, I think that could have avoided them.
Sure.
Oh, yeah, again, the reason that we are here and the kind of technology, the kind of service we provide to the community banks is to help them equalize with the other fintech monolines so that we'll make it as convenient, as speedy, as easy it is for someone to apply for a loan from your bank as it is from Lending Club. So that's why that's the kind of service we provide. That's what we do.
Well, I know our time's running short. Do we have any more questions? Yes, Julie.
Yesterday, we talked a little bit about the situation that Janet raised of, a local disaster and all of a sudden credit not being available. And I think we all expect that someday, hopefully not too soon, there will be an economic downturn. Are we going to see a tie-up in credit availability, or do you see fintech companies becoming aware of and making allocations or adjustments for those types of future events?
Well, I think that, I'm glad you mentioned that. I think that I would add that as one more of my argument why I think some of the tech companies, it's difficult for them to become a financial service providers. It's exactly because of those kind of black swan scenarios. I don't know if they know how to deal with that. Especially for some of the monoline financial service providers, such as the Lending Club, the CapEdge, the source of capital is not stable. And we've seen what happened to the securitization market in 2008. So I think similar things could happen. So that's my opinion. I don't think that they will be nimble enough to shift. I think there will be a lot of risk among those fintech service providers.
I agree as well. I think that as banks have gotten a little bit faster at making loans, the fintech lenders have been falling. It seems like that their loan quality is probably going down a bit. And that in a good market, it's fine when you're charging 40% APR and your loan losses can still be 10%, and that's fine. But in a downturn, I wouldn't be surprised if there's going to be a lot more consolidation in the industry in a downturn. One source of capital that I hope in the next downturn that steps up in a big way is capital through the community development organizations, CDFIs, the SBA. I know in some of the disaster areas they've done a lot to kind of help push capital out into businesses that need it a lot, kind of through the banking industry, and kind of still provide some of that backstop where banks might be kind of inclined to tighten down otherwise.
Gotcha. Well, again, I appreciate you guys for participating on the panel, and I will say that maybe some of the takeaways that I'm getting from this conversation is, for the regulators out there, as Kate and Trevor said, maybe there are ways to, not to sound too cliche, to think outside the box in terms of, how you can help your banks be more innovative and do things, perhaps on the capital side, things like that. For the researchers, keep doing what you're doing. Obviously, take some of these statements. I'm sure there's going to be data over the next few years. Come up with these hypotheses and test these things, see what happens. Obviously, whether it's core provider, whether it's the competitive landscape, there's certainly going to be a lot of data to parse over in the next few years. And as far as the bankers are concerned, as we've been seeing here, look at FinTech as not necessarily a threat, but also as a potential opportunity as well. So thank you guys again for your time.